Hello and welcome to the Capital Stewards podcast. This episode is all about alternative and private investments. I wanted to cover some common myths and misconceptions that I hear frequently about alternatives. First is that they really aren't all that alternative or different from other types of investments that you make in your portfolio. Most involve buying either the equity or the stock of a company or lending money to a company or buying a bond, just like publicly traded stocks and bonds. The difference is that usually alternative investment funds are private. They don't trade on an exchange, and the information about them is hard to get. That adds to the mystique and perhaps the mythology in the alternative investment universe. So we're going to talk about how private or alternative assets aren't just for the wealthy, the existence or non-existence of the private manager's secret sauce that drives all those high returns that you hear about in the media. And we'll talk about how you should think about private assets and alternatives in your portfolio. So let's dive in. So myth number one is that private assets are for the very wealthy and they're not for me. While investors do need to meet government minimums for personal wealth, income, liquidity, fund structures have been evolving over the past decade to become more accessible. Originally, investors needed to commit $1 million, oftentimes more, just to access private investment funds. But fund minimums now can be $50,000 or $100,000, and so that makes alternatives and private funds a real option for more investors. So if you've got at least $1 million in liquid assets, you should at least be considering whether private investments should supplement part of your portfolio. So myth number two is that all of these new fund structures and innovations mean that I really don't have to give up access to my cash for 8 to 10 years like I did in the past. And this is a myth. For investors that are new to private assets, most funds require that you commit a minimum amount of capital up front, which they'll then call or draw down to make investments. So you tell them how much you're going to invest, but you may not actually put that in the fund right away. It'll get drawn down over time. You kind of keep the cash on hand yourself. Private funds generally expect to make investments over an 8 to 12 year time horizon. Historically, investors needed to wait until the latter half of that time period to start getting major distributions back from the fund. But new innovations like interval funds suggest that maybe some of that liquidity will be available on a quarterly basis. And some more traditional funds also promise faster liquidity. However, I think a lot of this is a little bit of a myth. I caution investors here a lot. The reality is that all those promises of early liquidity are dependent on the supply of cash that's available in the fund and the number of investors that are looking for distributions. So the reality is everyone tends to want their money back at the same time, and that is when things are going poorly. And so even though there is a mechanism to provide more liquidity, which maybe hadn't been there in the past, if everything is going bad and everyone wants their money back at the same time, there's not going to be enough liquidity for everyone to get. That was in the news a lot last year with the REIT, which is a Blackstone real estate fund, wasn't able to meet the demand for quarterly withdrawals. Investors had to wait their turn. So despite the innovations in the space, all of which I think are helpful for investors, I would not plan or expect to receive the capital back that you put into those funds until the end of the fund. So you want to make alternative investments with a long-term perspective and plan on sticking it out to the end, despite whatever sort of perceived liquidity might be there. So myth three is that private managers have a secret, and that allows them to drive special secret returns that everyone must access. Here, I want to particularly talk about private equity because that's what is most often associated with those really high returns. You can split private equity into two categories: private equity, the traditional buyout side of that, and venture capital. Preqin is a firm that tracks sort of the returns in the private investment space. And over the last 10 years, traditional private equity buyout funds have generated average returns of 28.3%. Venture capital funds that invest in startups, usually in the technology space, that's typically what you hear about, those have averaged about 19.9% over the last decade. The S&P 500 that you can invest through SPY in an ETF in your brokerage account split the difference with a 10-year average return of 20.97%. So those returns from the first quarter of 2014 through the first quarter of 2024. Stephen Kaplan is an academic thought leader on private equity at the Booth School in Chicago, and his work suggests that private equity outperforms the S&P 500 by about 5% a year. So whether it's the Preqin data or it's Kaplan's work, private equity funds do produce outperformance, The question is it so significant to overcome the requirement for locking up capital without liquidity for a decade? And each investor has to make that decision themselves, with their advisors in context of what their goals are. In my view, for investors that have plenty of liquidity, the extra return can be worthwhile. Why not? But it's not a panacea of wealth building. I think investors can stay in public markets and do just fine. If you're thinking, man, I have to access these, sort of private equity returns in order to have significant portfolio returns over time, I think that's not the case. I think private equity offers some diversification, some access to different kinds of equity holdings that you obviously can't find in public markets, and that's a great thing. But it's not a panacea for building wealth. So where there is sort of special sauce, it's generally linked to the deal flow that private equity funds and venture capital funds have access to. Buyout funds spend a lot of time and energy looking for companies that are available for sale, perhaps at a below market price, or that have an issue that they think can be corrected. Perhaps they're owned by the founding family and maybe haven't been optimized for business, maybe have been more optimized for the needs of the family over time, things like that. Venture capital funds build relationships with company founders over many years, and they try to get the first cut, so to speak, at investing in new companies. And when startups happen, they generally only need a few $1 million at first, so they don't need a lot of investors. So whoever gets the first kind of crack at those deals often gets their money in first. So if there is any secret sauce in the private equity space, it's probably just related to their ability to have access to deals. But again, the returns, they are, better, particularly when we look over the last decade at the buyout space, but they're not a panacea. And I think the best way to think about them is as a part of your portfolio, not something that you just have to have. If you're thinking about buying private equity, particularly on the buyout side, there's myth number 4, which is that private equity funds borrow a ton of money and they lay off workers. They're just corporate raiders. This, while this was probably true in the 80s and maybe the early 90s, it's less true today. Private equity funds, both buyout and venture funds, do push their portfolio companies to create strong operating performance. They're investors, they're there to make money. That makes sense. And in recent years, that has led to a single-digit reduction in employment. So, maybe the total number of employees at the company goes down 6, 7, 8%, something like that. But that's very different from mass layoffs, I think, that you might expect, or that you think maybe are reported in the media. They generally make the existing operations more efficient with layoffs, and then they hire in areas where they can expand or grow the business. So gone are the days of kind of pure financial engineering where PE funds bought the company, laid off a lot of people, borrowed money, reaped all the profits, and then left a mess. That really doesn't happen anymore. Generally, modern PE funds are investing to restructure and grow a business. Again, Stephen Kaplan's work here shows that by a wide margin, PE firms are looking to grow the revenue of the business as the primary source of value creation. It's not as much focused on cost reduction or restructuring. Reducing cost is a distant second to their sort of investment thesis on average, and the leverage is even further down the list. So all the financial engineering you think of isn't even in the top few. So they're buying businesses that you think can grow, that they can optimize a little bit, and then they use a little bit of leverage to help boost their returns. The other thing that I think is important is that management teams in PE-backed companies tend to own about 15% of the company. A lot of times the CEO will own 5%. That's significantly more ownership than publicly traded companies. That helps align management with the owners, which is you if you're invested in a private equity fund, much more effectively than what you see maybe on a public company. So the PE space is by far this world where investors swoop in from afar and restructure the financials of a company and then leave. They're very engaged. They drive ownership and good results for their owners. So let's switch gears a little bit. Myth number 5 is that private debt has grown too fast and it's the next financial crisis waiting to happen. Private debt is the other side of kind of the private investment equation. Instead of owning shares in a private company that benefits from its performance, investors make loans to that company. Typically, these are private equity-backed companies, and loans are from private credit funds, and they're used by private equity funds to buy the company. So all of this ecosystem sort of works together. Because of the leverage that's involved in PE transactions, they're riskier deals, and the banks that used to finance a lot of this stuff before the financial crisis have largely had to pull back from that world because of the regulatory and capital requirements that are associated with the loan. So as you would expect, the loan interest rates can be pretty good. They tend to be 9 to 13%, low double-digit returns. That's higher than both investment-grade commercial credit and what you're going to see in sort of the publicly traded high-yield or junk bond market. That market has grown a ton since 2008. That's a technical term. The banks, like I said, have pulled back, and credit funds and institutional investors have kind of stepped into that space to provide financing. I don't view that rapid growth in and of itself as being a huge problem. The issue with the rapid growth is when fund managers start chasing bad deals that aren't, and there aren't enough good deals to invest in, right? So the sort of quality of the industry goes down. In reality, the total assets under management for the private debt space is less than 10% of the assets under management of private equity. You would think it would be a lot more. PE firms have more than $1 trillion currently in sort of dry powder or cash to invest. And so if you think about that, there's a lot of white space still for private debt to grow without much of an issue, without having to sort of chase bad deals. So I don't think the problem is the pace of growth in and of itself. I think there is potentially a problem brewing with the rapid rise in interest rates that we've seen over the last few years. If rates continue to remain high and the economy slows down, the companies that were lent money are going to start to have trouble making those interest payments. They're already having trouble. They've just been able to successfully kind of defer the pain. A lot of those loans got done in 2019, 2020, 2021. Interest rates were a lot lower. Now debt payments for those companies, interest rates might have gone up, the sort of the rates that we see might have gone up from, say, 2 to 5%. But that means that the debt payments for companies might have doubled, right? Maybe even up 3 times in some cases. And so the longer that we remain in a really high rate environment, the more likely we are to see defaults in private debt and in this space. And so because there was so much growth in the industry, we don't have lots of history on companies, it's possible that there was some lending to sort of weaker players. We won't know until the tide kind of goes out. But when it does, I think there are some funds in the private debt space that'll be wishing that they had made sort of smarter deals over the earlier sort of part of this decade. So I don't think the rapid growth necessarily is a problem, because I think there are enough good deals for managers to get into. But I do think if rates stay high for an extended period of time, then I think you might start to see some issues in the private debt space. Even if that does develop and become an issue for the asset class, I think it's really important to distinguish what might be an issue for the private debt space and for the owners of private debt from sort of a contagion debt crisis that spills over into other areas of the economy. I think this is what you hear talked about a lot. The owners of private debt now are large institutional investors, pensions, endowments, insurance companies. They would certainly have to take losses on their positions if there were lots of defaults, and those investors would suffer. But because the banks themselves were less involved in the space, there's less leverage. My view is that the losses would be more isolated to the people that own it today. It's not going to impact lending sort of broadly across the economy. So private debt may have sort of looming issues, but I don't think that in and of itself is a looming major risk that's going to create an economic problem. It might just be it might be a problem that results from a slowdown in the economy, particularly if rates and inflation stay high. Myth number 6. Some real estate developers and owners are struggling, so now is a great time to get in and buy real estate, either through a privately held REIT or a fund. The real estate market is the tale of two halves. So commercial office properties continue to struggle for demand as office space. The demand for office space has been dramatically reduced since COVID, despite what you see in the news about return to office programs. Offices are operating about 60% of their occupancy levels, according to Castle Systems. It went down to about 55% during 2022, and it's only ticked up 5% since kind of the bottom during COVID. So the result of all that is that companies are reducing space when their leases come up for renewal, and office properties, as a result, are struggling. But other parts of the real estate market, retail, industrial, multifamily apartment housing, are doing okay. So the challenge in this space, and the reason why I think this is a myth, is that if you could buy a newly launched fund that was buying properties today that are valued based on today's interest rates, with today's debt levels, at today's occupancy levels, you get the idea. That actually probably does represent a pretty attractive opportunity to buy properties at lower values. The challenge is that many REITs, public and private, are perpetual in nature. So in addition to their ability to acquire properties at today's good values, you're also buying shares in all their prior holdings, and that stuff might drag on performance for quite a while. So I think there might be a buying opportunity emerging in some real estate spaces, but I wouldn't blindly assume that all real estate is going to benefit equally. And you really need to find a fund that's raising fresh capital and buying at today's prices. So I think diligence on what you're getting into in the real estate perspective or in the real estate space is really important. Also, I think too, in the private investment world, if you can stick a few $100,000 in a private real estate fund, You can also potentially buy a small local property on your own. You might be better off buying your own properties in your local community where you have a lot of specific knowledge than investing through a larger fund. So some of that depends on your propensity to buy your own properties. But if you're thinking about investing in alternatives through a privately held REIT, you might think about doing that yourself in your local community as opposed to doing it through a fund. Again, some people, the fund structure will make more sense. Other folks, sort of direct investing themselves will make more sense. Depends on what your goals are. But I wouldn't just assume that now is a great time to buy. So let's go pile into privately held REITs. Myth number 7. All alternatives are designed to provide higher returns than the public markets. Remember, as an investor, your goal is to give yourself the highest probability of accomplishing your goals. That usually means earning consistent compound returns over time with the lowest risk possible. Some alternatives, like hedge funds and infrastructure funds, aren't designed to produce eye-popping returns. I know that's probably shocking to some people, but they're not. They're designed to produce sort of mid-single-digit returns consistently across all kinds of environments. In 2022, a lot of investors learned the hard way that in a world where inflation is higher and interest rates are more volatile, bonds don't necessarily provide the best diversification. Bonds and equity declined in 2022, but strategies like absolute return hedge funds and infrastructure continue to produce those steady Eddie returns despite what was going on in the environment around them. So it might make sense to have some alternatives in your portfolio that don't drive returns, but they reduce risk and volatility over time. Again, there's a return sort of trade-off there, right? So you say, hey, is it as good as buying sort of QQQ or the stock market? Probably not, but also probably comes with lower risk. So it's important that you think about making that risk-return trade-off, and everything in your portfolio is not necessarily designed to produce super high returns. And the goal of alternatives can be to help provide diversification, not just to provide returns. Myth 8, alternatives are all the rage. So the fund that I'm being sold should work out okay. There's a reason why the government has net worth minimums for certain kinds of alternative investments. They do not have the disclosures and the investor protections that an ETF or a sort of what we call a 40 Act or a traditional mutual fund has. Investors are essentially entering into a private business contract with an investment manager, and there's an assumption that both parties are sophisticated because of those government limits, and that they can do their own diligence, they understand the risk that they're taking. So due diligence is very, very important in the alternative investment arena. That involves everything from reviewing the prior performance of the potential investment, looking at the financials of the fund and the fund's sponsor, the larger management company, and understanding the background and the experience of the people that are there. So it's vital that you ensure that someone is doing the legwork on potential alternative investments on your behalf, and you're not doing it yourself. So don't be lulled into kind of a false sense of confidence that because everybody's talking about alternatives and maybe somebody pitched you an alternative fund, that it's necessarily a good idea. The most important thing in the alternative investment space is that you do your homework to prevent a total loss of your capital. And that kind of dovetails into our last myth, which is myth number 9. All private fund managers are created the same. This is kind of, like I said, kind of related to my point about due diligence, but I wanted to highlight it a little bit more. There is much more dispersion between the returns of private investments than there is between mutual funds and ETFs with similar mandates. What do I mean by that? So if you pick the wrong mutual fund, you might underperform the market by a few percentage points, but your performance is pretty likely to be sort of close and sort of similar to the public market. There are exceptions to that, but generally speaking, that's the rule. Managers tend to herd and they produce similar results because they're being evaluated based on their performance in the benchmark, and so they don't want to get too far from it. In private markets, the ability to pick a manager that will be in the top quartile of returns is usually critical to your private market investing success. The best performing private equity funds may produce those sort of annual returns that are in excess of 20% or more per year, but the worst performing funds might produce only single-digit returns over a decade. And remember, you've committed all that capital up front, and you're only getting 3, 4, 5, 6% for it over time. The difference is hugely significant. So that new shiny private equity or debt fund that somebody's selling you isn't going to produce the results that you expect just because it's labeled private equity or debt. Some funds do really, really well. Others don't do well at all. So choosing the right fund structure and the right manager are paramount to success in the private investing space. So it's really important that you evaluate the manager and their track record. And remember, their prior success is not necessarily predictive of their future performance. So what's their investment thesis, and why are the things that they're doing now going to drive returns going forward? So it's important that you do diligence on the fund from a financial perspective. And then also make sure that you think about choosing the right manager in the private equity space. So there's just a lot more that you need to think about before you invest in alternatives. Again, that doesn't mean that you shouldn't own them, but it does mean that you should do your work ahead of time. So I hope you found this discussion helpful as you consider alternatives for your own portfolio. My view is that for the right investor, alternatives can be an important building block of your portfolio. Generally, you need to be able to commit significant capital to these strategies for years or even a decade for it to pay off. Like I mentioned earlier, alternatives can enhance returns, but they're not a panacea. I mean, you shouldn't feel pressured into using alternatives just because everybody's doing it. There are lots of ways to achieve your investment goals, and alternatives, while they're popular right now, are only one of those strategies. So if you have questions about existing private investment holdings or alternatives, or if you're thinking about whether you should have exposure to alternative investments, reach out anytime. I'm happy to talk about your specific situation further. All right, and we will see you on the next edition of the Capital Stewards Podcast.